Your plan is not waiting for you to start. It's already started.
Well, you have a paycheck. Don't you have money?
What's really defined is on track. And are you really considering all the variables in the plan?
These are things that people are not considering now.
It's not necessarily that people refuse to save. I think it's their...
So there's a 73% probability that somebody's going to make it to 90, but there's a 75% probability that they're not going to have any money.
People are being so safe with their investment, it's actually unsafe to do.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
This is John Smallwood, and we are back on Money Isn't. And today, I have a really special guest. I know they say that every single week, but every week the guests get better, the conversations get better, the comments become better, good, bad, and ugly. I love them all. Keep on bringing them. We are getting better as a result of it. But Rob Marks joined me as a summer intern in, was it 19?
I think it was 17. Actually.
17.
Yeah.
It was 17.
Yeah.
Was it really?
Mm-hmm.
Well, welcome to the show.
Thank you. Thanks for having me.
Okay. Now, you were at UDEL.
Mm-hmm.
You were in the certified financial planning program, right? Is that what was the major?
Yeah, so it was a double major. I had finance, just like the general finance degree, but I also did a major in financial planning and wealth management because I kind of knew going in that I wanted to kind of pursue that and be more of a certified financial planner. And then looking around for internships, I was looking for CFPs in the area, and Smallwood Wealth Management comes up.
How many people did you reach out to?
10, 15.
And how many people responded?
2, 3. It's pretty incredible. I mean, you talk about in the industry that there are, the industry tends to be a little bit older. So you would think in terms of, bringing on new people, succession planning, however you want to frame it, that you'd be excited when someone says, hey, I'm looking to become a CFP. I want to go through the right way. I'd love to learn from you. And nothing,
Crickets.
Yeah, crickets.
Right. And everybody's complaining, I can't find any good help.
Yeah.
And my position is like, this kid's reaching out to us.
Yeah.
He's hungry. Let's get him on. Let's get him in for an internship. Now, when you walked in the front door, you had a vision of what being a financial planner was like. Mm-hmm. And in that first month that you were with us, like, what happened?
Yeah. So it was actually pretty incredible because when you are in school, they tell you here are the different basically silos of not only what are you planning for, but kind of how to think. And in the first month and beyond that, being here and really being exposed to cases and the way that you guys work, I really got to see how much more there is to it, that it's not even just the math. There's the psychology and making people feel comfortable and okay with the strategies.
It's the relationship.
Yeah.
Yeah. I mean, you could have the best financial planning software in the world and there's no relationship. And it's like, what? Yeah. What are you doing? Right? Mm-hmm. Because money isn't a lot of things, right? It is a lot of things, but it isn't. Like when I came up with the new podcast and it was Money Isn't, what popped into your brain at first? Like, what is he talking about now?
Yeah. I mean, because a lot of virtually all financial podcasts are money can do this for you. Money can do that for you.
Accumulate as much money as you can.
But money isn't is more of, why isn't it reaching this goal or why isn't it performing this thing for me?
Right. Right. And it's so in this journey, you come in, you spend the summer working with us. Mm-hmm. At the end of the summer, you grew up dramatically. Mm-hmm. You walked in the front door, you were like, week one, you were shaking. And you're like, oh my God, I don't know what I'm going to do. This is so different than what I thought it was going to be. You want me to do what? You want me to do this? You want me to do this? And you joined us at a time where we were short staffed and we needed help. And we're like, let's just give him as much as we possibly can and see how he does.
Yeah. We were doing through different changes and all different
broker-dealer changes, RIA changes, software.
So, at the time, right, it's a lot to take on because not only are you trying to learn, the kind of the basics of the job, we have all these other factors that come into, financial planning for the client is just one piece of it. There's all the tools, then, choosing what you're going to present to people. Like there's just so much more to it. So, it's learning a lot at the time, it could be like a little stressful trying to piece it all together. But now that I've been through it, it just gives you so much of a deeper understanding of just what it takes to really be a financial firm and to write by the clients.
Right. And so as a certified financial planner, you take on a fiduciary responsibility to make the best decisions and the best recommendations for your clients. What you learned in some of this was a little bit different than what you actually do in reality, because some of the recommendations that are, textbook recommendations have no application.
Oh, none. When in my schooling, they did a lot of things right, but when it came to certain things like annuities and life insurance, they kind of just they skimmed it. They talked about the definitions, or they'd say annuities are high fees, and they moved on. And it was kind of incredible, learning, just seeing the true pros and cons, and not just in a textbook, in a chapter, on a test, and out the window it goes.
So opinions and biases and hearsay were driving the financial planning
from the start. Yep.
Yeah, which is the danger that we have, right? When opinions, biases, and hearsay dictate how you make financial decisions, you're not making it with full information. That's the thing that I wanted to teach you, and I think I did.
Yeah.
Okay. Now, 2017 to 2024, you've really grown a lot, even from the first year that you were here full time. What do you designed today's presentation? You wanted to hit the retirement issues that you're seeing over and over and over again. What was the reason that you picked this topic that we're going to discuss? And we haven't even really defined the topic for the listeners, right? This is retirement issues. This is retirement factors. These are things that people are not considering that they should be considering now to make their plans more successful. And I don't have the right title for this, but in essence, when you showed me the slides that we were going to use today, I was like, oh, this is all about being real in your assumptions, right? So why did you pick this?
So I picked this because you hear a lot of people my age that they may save a little bit, nothing defined, more of just, I happen to build up some cash or this or that. And there's not really a comprehensive strategy to say, this is the roadmap, this is where you're going. Are you preparing yourself today for the future? And people think the impact of today, saving, it will help me, but it's like, if I wait a couple of years, I have, this lifestyle cost or that debt. And it's like, I can wait a little bit and then I'll get my plan sorted out. And
I just want to have fun now.
Yeah. Like people, really, it's like people think that, my financial plan is waiting for me to start planning for it, as opposed to it's already started. Like yes. you haven't planned it out, but the thing's already working for you. So I want to make sure that when we're going through this, that people understand, why you want to start a little bit earlier and what's really defined as on track. And are you really considering all the variables in the plan to make sure that you are properly prepared for retirement?
I think it's really interesting. What was popping in my brain as you were talking was the habits that people create, right? When you're in your 20s, you're in your 30s, you're in your 40s, the habits of savings and the way you approach money were formed in your 20s. Because up until out of school, most people never even touched their own earned dollars, right? They might have a paper route. They might have something like I had a boat washing business and I would get cash and then I would spend that cash. And then I had set some goals and my father's, I was really into boats, right? And I wanted this big inflatable boat. And he said, if you save up enough money to buy the boat, I'll match it and buy the outboard engine. And they were both about the same price. I think they were both like $900. And I was like, I got to wash a lot of boats. He goes, you do. How long do you think you're going to do it for? And I'm like, I can get that done by, this was like early May. And I said, I can get that done. I think I was like 14. I can get that done by like July. He goes, go do it. And I went and got a whole bunch of boats. I was working after school. I was working weekends. I was, as soon as school got out, I was there. And I had it all saved up. And that was the foundation of like, oh, the habit of saving for something that you want. And that's something that people don't understand what they have to do to hit their goals.
Right. And people really, because they haven't laid it out, especially in the earlier years, it's fuzzy. It's, I know I want to get a house someday. I want to do this.
I want to get married.
Because it's so hypothetical and so it's so fuzzy that is, what am I really saving towards? I know in general I would need to save to get a house, but like do I know how much it's going to cost? Do I know all these other annual expenses that are going to come through? So I think it's not necessarily that people refuse to save. I think it's they're unintentional with their plan as opposed to being intentional with the actions that are going in.
That's really insightful. So let's talk about for a second here. So everybody has a certain, there's habits that they're creating every single day. And if you create the wrong habits in your 20s, you're undersaving, you're overspending, you're underprotected, you're going to replicate those pretty much throughout your entire thing. And you're going to arrive at a retirement zone and you're going to be like, I have to go backwards? Yeah. And people don't really get that. And like, well, I'm just going to spend money and it'll just magically happen. Not necessarily. Some people that happens for, but most people it doesn't.
Well, you have to think too, like if your savings rate, let's say you're a little bit younger, your savings rate right now, you basically have cash coming in and you have your lifestyle, rent, house, whatever it is. But as you get older, you have kids and you have all these other goals and expenses that keep popping up. And if you didn't prioritize saving when they didn't exist, it's going to be really hard to prioritize it when you do have those financial pressures.
Yeah. So the first slide that you picked was life expectancy probabilities. These are all JP Morgan guide to retirement slides, which you'll see the screen share. But why did you pick this one? Like, what was your thinking here? Like, why is life expectancy so important and the probability of life expectancy?
So the reason I wanted to start here is that when people talk about saving for retirement, it's kind of, again, fuzzy as to how many years am I really going to be around? How many years do I really have to
My
save
mother
up for?
lived to this. My grandmother lived to that. My uncle lived to that. Nobody in my family lives beyond this age.
Exactly.
All these limiting beliefs based upon past stuff that has no relationship to the people.
It's things that may have been personal to that individual. It's things that may have just been a result of the time, nutrition or whatever it is. So like you're going off of that past data to basically forecast, I'll live to this age. So what I wanted to do was start off to say, well, how far into retirement do people actually, make it, right? And the stat that really showed out to me that's on this first slide is if you were to look at a married couple and say, all right, how long is at least one of them around? What you'll see is that by age 90 and a little less than half the cases, there's still at least one person around. That doesn't mean that they make it to 90. That means that it means that they've made it, they may go beyond 90, right? So if you assume, someone retires at 65 years old, some people retire earlier, some people retire later, and some people don't retire. And that's great, right? They love what they do. But if you are retiring at 65 years old as a couple, you have a minimum of 25 years of retirement planning to do in, almost half of the cases there. Right. And it may be more.
And in a lot of cases, even longer.
Yeah.
And I think people really underestimate how long they're going to live and what their quality of life is going to be. I remember, and it still goes on every single day, many, many financial plans that we encounter that were done outside of this business are designed to run out of money by age 85. Mm-hmm. And people don't really know that.
No.
Like you have a high probability of having money at age 85, but you have a much higher probability of at least somebody. What this chart is basically telling me is at 85, there's a 71% chance that one person is going to be here. Mm-hmm. Right?
Yep.
At 90, there's a 43% chance that somebody's going to be in the household still. Husband and wife, married couple.
Yeah. And that's, if you're looking at this, you'll see that 71%, that 43%, those are national averages. That's not even saying that someone's fully healthy and that's the expectation.
Yeah.
If you boost it to being someone who's non-smoker, excellent health, for the age 90 piece, it goes up to 73% chance that one of the people are still around at 90.
So there's a 73% probability that I'm going to make it, that somebody's going to make it to 90. Mm-hmm. But there's a 75% probability that they're not going to have any money.
Yeah.
Or 50.
Yeah. So it's just incredible. Like this is why I wanted to start here, to show people that the amount of years that you're saving for, no one knows like what for their life, like what that number is going to be. But if you just look at the stats and the expectations, I mean, it's a lot of years that you're saving up for that people may not realize, especially if it's designed for 85 and half of them are getting to 90. And where's that money coming from?
Yeah. I mean, if you look at it, both members of the couple at age 90, if they're non-smoker and excellent health, it's a 23% chance that they're both going to be here. Yeah. All right. A 73% chance that one's going to be here. That's freaking that, and how many people are going to go beyond 100? Like these charts, these life expectancy charts are using historical data, right? It's not projecting how people are going to live into the future. They haven't put that into the charts yet. Like I believe people listening to this podcast, they're in their 30s, they're in their 40s right now. The probability of them living to 100 and beyond is much greater than somebody that's in their 70s at this point, right? So for many, retirement's going to be far longer than they ever expected and far more expensive. Yeah. Right. So I want to jump to the next slide for a second, right? Because we had this retirement savings checkpoints. People are always like comparing themselves to stuff, right? And that to me it's not a good way to live your life, right? But you need to have a guide of like, if I am 45 years old and I make under $90,000 a year, where should I be? And my household income is, let's say, 90,000 and I'm 45. How much money should I have saved up already?
Right. So according to this, they're saying 270,000. And I want to go through a couple of the numbers here, but if you look at their assumptions on the right, there are some issues even with the modeling on this. So I want to say that the 270 isn't even enough for what they're forecasting here.
Correct, because they're saying 5% savings rate, a diversified portfolio of 60-40, post-retirement portfolio 40-60, so they're flipping it, right? They're going less equities and more bonds, an inflation rate of 2.5, which is completely wrong.
Think about that. The inflation. So the inflation rate, I believe for the past 3 years, we had, it was 4%. It was somewhere in that 7-8%, and it went back to 4%. So if you're trying to forecast this on your spreadsheets at home, this just threw all that math off. And 3 years of compounding from inflation just threw it all off.
Nah. And what's interesting is, the overwhelming amount of the income for somebody under 90,000 will be Social Security, right? That'll be a higher percentage than somebody earning over 100,000. Yeah. Right. So in the same chart with the same, now the chart with 100,000 is saying instead of saving 5, you should save 10, which is, to me, you should always be saving at least 10 up to 100,000. And that's orchestration through proper planning, right? But the family income at 300K a year who's 45, they need $1,495,000.
Yeah.
Right now, they need to be at that level
in order to be considered on track. And if you look in, again, these model assumptions, and they can't plan for everything. But let me tell you a couple things that they aren't planning for here that are going to mess with these numbers. If they're assuming that it's a household married couple and they both make it to the primary earners age 100. So that's assuming that someone doesn't pass early, right? Because remember the stat we just said, that in roughly half the cases by age 90, one person's here and one person's gone. Yes. And they just lost that lower Social Security at some point along the way. Right. Which hurts the chances of success.
And how many pensions have you seen where people come in and it's life only? Yep. My wife will be fine. My husband will be fine. And I'm like, it's $50K a year that's coming in that goes away tomorrow. Yeah. And like, how are we counting for? It'll be fine. And it won't be fine.
And even too, right, some of the other things that they're not forecasting in here. How many, the percentage, I don't have it on hand, but the percentage of people going into long-term care facilities, that's $10,000 a month for the person.
Post 80.
Yeah. There's tax rates, federal tax rates change, state tax rates change, people move. Like, there's all these different factors that are just like off in the projections, which is why when they're saying for, the 300K family and they're 45 years old, they're saying I need roughly 1.5 million. That's not enough. If they're really maintaining the lifestyle, that's not enough.
Right. Now, what is the biggest thing that I taught you about these calculations? That they're what?
Well, so when you're looking at these, right, they're going probably off of an average return here as opposed to an actual return.
Well, it's an average. It's an average return. It's not an actual volatility adjusted returns, but it's also a linear calculation. I'm making 3% more per year. I'm making this, my expenses are going up by 3% a year. You've realized that that's completely freaking flawed.
Doesn't work. Yeah.
I mean, some people double their income in a year. Other people half their incomes in a year, right? And then they're stuck at the higher savings rate or the higher lifestyle rate, and they're imploding themselves. We had a conversation yesterday with somebody that I'm going to just burn up my retirement savings in my early 40s because I want to take a year off. What are you thinking?
Yeah.
What are you thinking? You get one exponential curve during your lifetime. Every time you break the curve, you have to start over again. And that all those gains that happen on the back end, you're just capping them. You're just you're destroying the back end.
Yeah. And you're destroying the back end too when you would be of retirement age where you're not earning more and bring that income in to kind of supplement this. You're basically choosing today's enjoyment and sacrificing the planned success overall for tomorrow.
Yeah. And I think what really bothers me about these calculations is that they are not really, if somebody's saving 10% and they're making 300,000, that means they're only saving 30,000. That means there's 270,000 between taxes and lifestyle going out the door. Yeah. And on a $300,000 income, New Jersey, FICA, federal, you're probably talking about 80,000 maybe. So now it's a $200,000, need for lifestyle. And somehow what in the financial planning classes, I think the biggest fallacy is what percentage of your income do you need in retirement?
Yeah.
You only need 70%, right? That's the calculations that they're throwing out.
It's like, well, you'll pull back a little bit, you'll
sit
downsize,
home, you'll watch
do this,
TV,
you'll do that.
You won't go play golf every day because it's too expensive. You won't go play pickleball every day because you turned your ankle. And the orthopedics love you, and now your medical expenses are up, right?
Yeah, I mean, you've shown me in different cases that we've worked on over the years that you would think that someone retires and let's say they have $100,000 lifestyle and suddenly it's 70. Doesn't happen at all because you went from working 40 hours a week where you were earning money during those 40 hours to having 40 hours a week to spend money in addition to your normal lifestyle.
And not assuming the commuting time and all that wonderful stuff, right? So now you got to fill 50, 60 hours. How do you do that?
Yeah.
Money isn't everything, but without it, you're not doing anything, right? I mean, let's really think about that, right? Like, if you don't have money, you are not having a good retirement. I mean, you could live in the woods. Somebody sent me a picture yesterday of this. They were up in Nova Scotia. It was a beautiful wooded area with a tiny little cabin, tiny little cabin on this beautiful rock thing. I'm like, is that an Airbnb? I'd like to go spend a week there, right? And just disconnect from the cell phone, right? But like, whoa, like that's like, you want to live in scarcity or you want to live in abundance? Like, that's the whole thing. Like, these charts are gearing to, like, if I'm making 300,000 and I see I have 1.4 need, but I have $1 million saved, now I'm in lack.
Yeah.
Now I'm feeling shitty about myself, right? But then, or if I have 2 million, I might be feeling overconfident because the measurement's wrong. And that's measurements against some industry average and or benchmark make zero sense to me. They should be a measure against what it is that you want. Like, this is my lifestyle. This is what I'm putting away. This is how I want to live and how I want to live during my entire retirement, not just the first 5 years.
Yeah.
Right? So, this is something that the benefits of saving early and investing, we've talked about this 100 times. And like we have lots of clients who we might have their 401k plan as part of the plan, and there's 50 employees. And how many people out of those 50 making less than 100,000, even over 100,000, actually contribute to get the maximum match?
I'll tell you, it's less than 50. I'll start from there.
Oh, it's much less than that.
It's much less than 50.
It's much less than that. And the mantra that I hear is, when I have money, I'll start saving. I'm like, well, you have a paycheck. Don't you have money? Right? So it's those habits. You got to keep coming back to, I'm looking at the wrong things and I'm missing the opportunities. Like this chart basically, I've been talking about this for over 35 years. I remember I did a presentation. I was 23 and I was in a company doing a retirement plan enrollment, and we were doing a presentation on the power of savings early. I'm gonna let you take it from here. And nobody in the room had jumped in, and there was like 40 people in the room, and I knew what everybody's balances were in the plan, and I knew what everybody was contributing, and I knew what matches that they weren't getting. And it was like, my goal was to get these people to do it. And it's just, they're not thinking.
Yeah.
So talk about this slide for a second, because I think this slide is absolutely incredible to me.
So basically what this slide is just trying to go through is saying, if you started investing at different points, where do you end up? So in here, they're assuming a 7% return, which we have issues with, but it's still the concept of earning, right? So the two numbers I really want to stick out here are that if someone was 25 years old and said, I'm going to put $200 a month and invest it in this 7% return, and I did that from age 25 to 65, the projections on here would say you have over 500,000 by the time you're 65 years old. Now, let's take it.
And you're never adjusting over the $200 per month. It's the same $200.
Yeah, it's the same cash commitment over that time frame, right? Now, let's say you have someone who is trying to, again, I'll save when I have money, right? And they wait until they're 35 years old, they moved up in their company a little bit, or they're self-employed and doing better.
So 10 years in,
I'll start saving. And they still save to 65, but they start at 35 years old instead.
Yeah.
Their projected savings on this is a little less than half of what they would have had if they had just invested in those 10 years before.
So that what I'm seeing is it's the purple line, if anybody's watching this. And it's $242,000. And they invested a total of $72,000 over that time frame. Is it the same $200?
Yep, it's the same. It's the same $200, and even if you look at that invested for the top, it's $96,000. So for an extra $24,000 over 10 years in the beginning of your plan, you basically doubled the portfolio in this.
The dotted black line on this is really powerful. So this is basically saying the guy who started at 25 and stops at 35. What happens?
Yeah, they actually end up a little bit ahead of the guy who started at 35 and went for the whole way to 65.
So 270,000 versus 240.
Yeah.
The investment for the 35-year-old to 65 was 72,000 total investment. The 25 to 35-year-old only invested 24,000, and he has 30,000 more.
Yeah.
I'm 56. Warren Buffett was a billionaire at 56. Right? That's a lot of money. But how much is he worth now?
Yeah, I know.
Right? That compounding chain happened all after 56, but he put the fuel into the plan and kept it there all the way through, right? I mean, it's interesting. This other piece in here is investing at 25, going all the way to 65, but they've got a significant deficiency in the way they think.
Right. They're so scared of risk that they say, you know what, I'm just going to do some sort of money market. It'll get me, I think it was 2.3% per year, little return. I'm going to keep it safe. And they end up with, I believe it's around 158,000 over that same time frame.
So a $96,000 investment in the safe conservative thing yields them 158,000 versus the guy who put it in the market and got $500,000.
Yeah.
Which one runs out of money faster? Which person has more enjoyment?
Yeah. I mean, even when you look at the cash, right, that 2.3%, I remember what we just said with inflation. Even their inflation calculation was 2.5% on here. So what's the purchasing power of that money? So sometimes it's people are being so safe with their investment.
Yeah,
it's actually unsafe to do.
Yeah, it's so unsafe. I mean, the risk is purchasing power. That is the biggest risk, right? So like 152,000 in future, value. What is that? 35 years?
Yeah.
35 years.
It's the 40 actually.
40 years with a 3% inflation rate. It's $46,000. So 150 spends like $46,000.
Yeah.
And inflation is not 3.
No, I know it's not.
Yeah.
Like,
yeah. So like, what do you want people to really gather from this? Like this chart, like what does this say to you?
this is saying that you waiting to invest for the sake of that I'll have more money, you are missing out on all of that compounding from the first 10 years and the additional compounding from when you actually would have started, in this case, at 35 years old.
Yeah. Yeah. Now, the reality is you start with the 200 and each time you make more money, you add more money, right? Now it's exponential.
Yeah.
Right. And if you look at the curve that's on this chart, the blue line is exponential. The other lines are flat lines. I mean, they're not completely flat line, but they're not exponential. There's not this, I mean, you look at the amount of wealth that's created from like 50 to 65, the last 15 years is absolutely incredible. It more than doubles, right? So it's sort of like these systems that are in play that distract people from savings, right? It's like, I don't have any money. I can't figure out how to save money. And we all know, like, everybody that you talk to wants to have $1 million. But $1 million is not $1 million anymore. It's sort of like an insult, right? It's sort of like, $1 million in today's environment in a money market fund for the short period of time that it's been here, it's about 5% to 4.5%. So $1 million is $40K. If you're making $40,000 today, you're probably having trouble, right? You're probably having trouble. Like, is that what you want?
Exactly. Like,
so how many 40s, how many units of 40,000 of income do you want in retirement? And the question is not, you don't even know. I'm 56. I don't know how many units I want. But the question is the maximum. Like, I want as many units as I can possibly get, and I want to live and enjoy today. And there's a unique balance that people have when they get the habits right, and your habits are right, you're making the right savings decisions, you're making the right balance, you're making the right components, you have the right level of protection, you get to the destination. And the odds of you sustaining your lifestyle are key, because that's really what you want. It's not about how much money you have. It's really about the lifestyle.
yeah. And really too, and I know we've seen this in cases over the years, that it's about hitting that really the appropriate savings rate, because you've seen people who enjoy today, there's no savings rate. And then for retirement, you see the anxiety that they go through. You also get people who are saving a ton, right? They get these huge savings rates and they're not enjoying today. And even when they get to retirement and they've accumulated more assets than for what their lifestyle would actually need, they're still afraid to spend the money because they've been in accumulation mode for so many years that they actually can't say, I earned this, I didn't enjoy it then, I can enjoy some now.
Yeah, and they can't have that enjoyment, and the kids will back a truck up and spend it all.
Yeah.
In most cases, like literally. I mean, I remember years ago, my dad had a client, never made more than 100,000, saved up a couple $1 million, and he wouldn't spend and enjoy any money. And his wife at 75 or 80 threatened divorce because she wanted to go spend money. She wanted to go enjoy. And they did a little bit, and then he died, and then she died not so long after, and there was 3 kids. And that money literally was gone in 5 years. What took him 80 years to. It was like, I was like in my 20s. I was like, what is that?
Yeah.
Like, what's going on? And I have seen that so many times replicate over and over and over again, because and then the people consumed it, and then they're like, oh, now my retirement stinks. I don't have enough money. Like, well, if you had been a better steward of the capital, it would have been great.
Yeah.
Like, you would have been fine. Like, the decisions that people are making, this is what you've seen. full-time financial advisor, you're a certified financial planner. You have been in hundreds and hundreds of cases and conversations with clients, fly on the wall, participating, actively contributing, different things. The repeating patterns are the same thing.
Yeah.
People don't really understand how long they're going to live for, how much money they actually need to sustain the lifestyle. And there's a belief, I'll worry about it later. And that worry about it later, like, you're always worrying about it. You don't have a solid plan. Like, so many people have come in and it's like, if you just work an extra, like literally, I have somebody that retired. We urged him not to retire because he had been in, a thing where he gets a pension. He could get out at 59. And it's not enough money. And we all told him it's not enough money. He's like, oh, I'll make it happen. And all of a sudden, he's in complete denial. He was in denial. Now he's in reality, like, oh, I made a big mistake. If he had gone to 62, the math worked so much better.
And it's really incredible when
just
you go
3
through
years.
that. Yeah, just it's not that, your plan has you wanted to retire at 60 and you got to work till 75. But sometimes it is, but a lot of times it's just working that extra year or two extends the lifespan of your retirement savings dramatically.
Yeah. Yeah, I mean, so the next chart that you had called up is the single stock volatility in equity returns. This is something that I think is really, really important that I don't think people realize. And I didn't know that we actually had this slide in the JP Morgan retirement.
There we go.
Bringing
some value here.
Bringing some value. So thanks for finding this. So explain what's going on. This is S&P 500 calendar year price and returns. And let's go through this slide.
I actually have a story with the single stock volatility here for my own story that when I guess I was about 14 or so, my dad wanted me to get a little exposure to investing. He's like, I'll give you a little money, choose whatever stock you want, pick it. And I'm 14 years old. The National Football League just signed a deal with Nike to have, the new jerseys and uniforms and everything is going to be my Nike. So I'm thinking, that's a pretty good bet. Over that time frame, those about 5 years, it's up 150, 200%, which is awesome.
Oh,
right?
Incredible.
Sets a false expectation for growth when it hits that way, right?
It's going to be worth $1 million by the time I'm whatever.
But as I got a little older, I'm like, if Nike has a bad year, a lot of my savings just go poof,
Correct.
So that was my single stock exposure. And that realization of the risk in the plan from just having the one stock, I, sold some of the gains. I put in a couple other things. And Nike kept going up, and I just kept doing that over and over. I eventually was able to kind of diversify the portfolio, still, increasing, but dramatically reduce the risk in this.
And didn't Nike have an issue a couple of years ago?
Yeah. And they had an issue a couple of years ago. And even if you look at their return over the past 5 years, might be off a little bit, but it's roughly flat, slightly negative. They had a big boom in 21 or 22, and then they lost it all by 23.
Yeah.
So
and never recovered. Everybody, this is going to recover. And it hasn't recovered.
Yeah.
History doesn't repeat itself.
Yeah. So the reason I bring that up is because a lot of people, when you say, okay, John, Rob, you convinced me I'm going to start to invest. I'm going to buy, however many shares of Apple or Coca-Cola or Exxon or whoever it is. And that's how I'll get it because
the top 20 stocks that are in the market, you can name them all. Right?
They're the big ones, right?
NVIDIA, blah, blah, blah. Yeah.
And so they just think it's this big stock. It's in, S&P 500 and I'll make a value there and I'll make a killing because they're going to be able to do this, this, and this. And sometimes if in the short term that will work out. The problem is that when you get used to that, you're missing out on the consistency of the index. So when we look at the slide here, what it's basically showing is over the past 30 years, how many times did the S&P actually have a negative annual return?
Okay.
And it's 6 times.
Over how many years?
30.
30
so from
years.
1994 to 2023.
Okay.
And
6 times.
6 times over that time frame, right? And it was down in each of them every year. At some point, there was a negative point, but if you just went from January 1st to December 31st, there have only been 6 instances in the past 30 years
Calendar
where that
year.
happened.
Calendar years. There's been other times, but it's calendar years.
Yeah.
Yeah.
Now, and we've seen these portfolios when people come in, people say, I'm going to kind of pick and choose from the 500 stocks in the S&P 500. I'm going to pick and choose because I think I can pick the winners.
Shouldn't I overweight blah, blah, blah?
Yeah.
Yeah.
Yeah. And what you actually see is that there are about 10 instances where of the 500 stocks that are in there, that 40% or more of them are down 5% in the year.
Even though it might be a positive year.
Yeah.
So like, okay, really hit that again.
So if I'm someone who's picking an individual stock in the S&P 500, I'm saying that, I'm picking, again, Apple, Microsoft, Coca-Cola, whoever it is, and they're in the S&P 500. They're a solid company. They've been around 100 years, and that'll be like, I'll beat the market because I'm going to pick the winner in the S&P 500. I'm going to pick what's bringing it up.
I'm going to bring the best. Yeah.
And what I'm seeing through the data is that in 10 different years, you had 40% or more of those individual stocks had a negative return of 5% or more, which is substantial. And again, that's 40%. That's not just saying that in the other years you had, 2% or something. That is nearly half of them over that 30-year time frame that you're posting a real negative return, not even flat. Right.
So I'm looking back at history, and I'm looking at 1998 here. The S&P is up 20%.
Mm-hmm.
If I look down on the chart, in that same 98 year, there were 181 stocks that were down greater than 5%.
Yeah.
Out of the 500.
Mm-hmm.
That's a lot.
That is a lot. And again, these are established companies. This isn't some, penny stock that made it or something. These are established companies, that really are like the top dogs in their sector. And they're still posting these kinds of losses on here. And you're trying to pick and choose and outsmart the market instead of just be the market.
And it's really interesting. So the psychology of the investor, the habit is, I believe that I can be better than the millions and millions of dollars that are being spent on research by these mega investment companies, right? And the research is basically saying he might get lucky. Like the dart theory, right? The dart theory, you throw, you pick your stocks by the darts, and it has the same outcome as the market. Like you're just not actually, it beats it in some cases. But the reality here is, this is the belief in the wealth management space that I see people all the time, is that I deserve better returns than the market. I'm looking for that magic manager to outperform the market. I mean, you're on the investment advisory committee here at Smallwood Wealth. You're part of that team.
Yeah.
We've done a lot of due diligence. We've looked at a lot of different things. We've looked at a lot of different outside, investment money managers, et cetera. And the overwhelming amount of them, what happens?
Yeah, they have a good year. Maybe they have 2 good years, and then they're down.
A really good quarter.
Like if that, and then they're down, and the client just says, "Oh, you're terrible performance. I'm going to go to the next person." Then has a poor experience, or maybe has another good short-term experience, and it's just this expectation that just because you have some investment knowledge that you can just beat the market. You have the secret to retirement, and that you can just invest in whatever stock and it's going up.
Right.
And it's
the
really
return Olympics.
Yeah. It's an expectation. Again, I have the Nike stock that went up, whatever it is, 100, 150, 200%. I'm like, oh, that's just normal. That's just, you pick stocks and they just go up like that.
They just go up.
Yeah.
It's like real estate only goes up. Really? Why did Midland, Texas get destroyed in the late 80s?
Yeah.
Right? Destroyed. Why did South Florida? Why could you have bought a condo on the beach in the early 90s in Miami for $60,000? Because real estate only goes up? No, they were trading for $300,000-$400,000 in the late 80s, right? Like it, and you can fact check me on that. But it is, because that's real. So, but again, the message here is, you have to, like, our blueprinting process, our wealth curve blueprinting process is designed to get an accurate picture of where you are. And then basically figure out this plan that you currently have. Because everybody has a plan, whether you have a written plan or not. You have a plan. That plan comes out in the blueprint. The blueprint says what?
Yeah, and it's when you look at the blueprint, you see that snapshot, that one pager. It's saying I've got some income that's getting taxed and saved, and here's my lifestyle. It's showing the assets versus the liabilities, and then underneath it you have like the protection components, right? And you see people all the time build up that they have all of this in their taxable accounts, and I'm doing so well, no protection in the plan whatsoever,
No foundation.
yeah. Or I save this amount, but they're telling us that they save 20% a year. And you look at the math and you go, well, you're making 500, your lifestyle is, 350, and you got taxes to pay. I'm confused. Where's the savings actually going? Right? It's going through that blueprinting process really puts to test your expectation or your perception of your plan compared to what's actually the numbers on paper as to, inflows, outflows, savings rate, growth.
Right. So really what I'm trying to do when we talk to a client on the blueprint is to say, everything on that plan is a macro, meaning like your income is a macro. You got a lot of flexibility on that income. Like you can move jobs, you can start your own business. Like what are you doing on that income? Like it's not just, you make $100,000 a year and you should save $10,000 a year. It's like, how do we find it? Right? How do we find the freaking money? Because like this blueprint shows, if I change nothing about my plan, where am I going to end up? Now we know that's wrong because all the variables are changing, inflation, taxes, blah, 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 right? Markets. But the reality is there's leaks everywhere. Like how much time do people spend plugging the leaks in their plan versus trying to get a high rate of return? And where's the fallacy?
Exactly. And it's basically the boat is sinking and you have the bucket and you keep throwing the water out of the boat, but there's still holes in the boat. It's still sinking. You're trying so desperately to get that out. You're not really digging deeper and understanding what is the source of the problem. Is it that my savings rate is off? Is it that I'm spending too much here? Are my taxes out of control when they could be, reduced? Like it's really, you have to dig deeper other than just saying that there's income and outflows and there's a shortfall.
Yeah. So most people that you've encountered we can't guarantee this, right? But do people pay more or less taxes than they should?
Oh, more.
Yeah.
Overwhelmingly more.
Significantly more, right? Mm-hmm. And when you pay more in taxes, what happens?
It's 0% return on your money.
Right. Is that a risk?
Yeah. Well, it's like, you have to think of it this way. Like if you look through your tax return, you really see the leaks in there. In the one tax year you saved, however many thousands of dollars, that's great. But what is the impact that now that you freed that cash flow up, that it can go towards protection or increasing the savings rate or just having some more liquidity? I mean, the power of it is not just that you saved however much money in that 1 year. The power of it is what are you doing with those funds now that they're in your plan again? Right.
I look at it as if, and I want to frame this in the right way, is if somebody paid $10,000 more in taxes and they do that every year, we already know the math is really ugly, right? I mean, it's a huge opportunity cost. But if I redesign my plan and I recapture that $10,000, which had a 100% loss if I gave it to the government. Yes, there's good things that happen out of paying taxes, right? But if I'm paying more than my fair share, I have an opportunity cost. I could literally put that $10,000 anywhere and reduce risk, right? Because the risk was 100% loss. Now I could put it in a money market fund. I could build my protection area. I could put it in the S&P. I could put it in small caps, and it still has less risk than what I was putting it in, right? So you got to frame, like, you got to really look at everything in the plan to really figure out, like, okay, is the information and the way I'm making a financial decision reality, or is it opinions and biases and hearsay, and are my decisions being colored by shitty information? And I think that's what you learned. And I think I've witnessed you, I've watched you grow, and I've seen the product of your relationships. I've seen people come out of, meeting individually with you, and having fabulous experiences. I want you to keep that up.
Yeah.
My goal was to have you become one of the best wealth advisors in the country. That's my goal for you, right? And you're really on your way. Yeah. So As we close out today, anything that you want to end with?
Mostly just, kind of what we've been hammering home here, like starting your plan is planning early as possible, because your plan is not waiting for you to start. It's already started. So why not be intentional and strategic with what you're doing with your money today to really optimize the success for retirement?
Cool. I appreciate it. Keep up the fantastic work.
Yeah. Thanks for having me on.
Thank you. Alrighty. Cut.